Imagine this, Elon Musk, the person who became the world's first trillionaire, and this kind of person might still struggle to pay cash for a $50 million yacht that he might want to add to his collection. This sounds impossible, right? But it's not. Because here's the secret that nobody tells you about being a billionaire. Almost none of that money is actually cash. It's locked up in stock, either Tesla shares, Amazon shares, Meta shares. It's all numbered on a screen and not exactly dollars in a bank. So here is the question. How does the ultra-rich actually get their spending money? The answer is that they don't sell their stock. They instead borrow against it. Which sounds insane, right? Why take out a loan when you're sitting on billions of dollars in assets? It turns out, it's not insane. It might be one of the smartest moves in finance. And it raises 3 questions we're about to answer. Is this legal? Is it smarter than just selling? And the extent of this loophole which billionaires abuse. Stick around, because by the end of this video, you'll understand the exact strategy the wealthiest people on earth use to stay rich, without ever really cashing out. Chapter 1. Why don't billionaires just sell their stock? If you owned $1 billion in shares, selling some of that seems like the obvious way to get cash. But selling comes with 2 big problems. The first problem is taxes. When you sell stock for more than you paid for, that profit is capital gain, and the government taxes it. In the US, long-term capital gains can run up to 20% or more depending on your income. Selling $1 billion in stocks and you could owe hundreds of millions in taxes instantly. The second problem is what selling signals to the market. Founders like Musk or Bezos own massive chunks of their own companies. If they suddenly sold a large portion of their shares, investors might panic. Maybe the founder knows something's wrong or has lost confidence in the company. That kind of panic can tank the stock price, which drags down the value of the billionaire's remaining shares too. So selling isn't that simple. It triggers a huge tax bill and can spook the market. Because of this, many billionaires look for a different way to get cash, one that avoids both problems entirely. Chapter 2. The buy, borrow, die strategy. The answer to that is a strategy known as the buy, borrow, die. The buy aspect is when billionaires invest in assets of stocks, real estate, businesses, things that grow in value over time. The borrow aspect is that instead of selling those assets for cash, they take out loans against them as collateral. Essentially, I own $1 billion of shares, so lend me cash, and if I default, you can take some of my shares instead, and they tell that to the bank. Banks are generally very eager to offer these loans, often at rates well below what a billionaire would owe in capital gains tax on an equivalent stock sale. This is especially valuable during the low rate years of the early 2020s, due to the low interest rate environment that was present in those years. So for example, say a billionaire needs $10 million for a house. Selling stock to cover it might trigger a $2 million or more capital gains tax. Borrowing that $10 million against the stock profile instead means paying interest. No tax owed at all, since borrowed money isn't considered taxable income. And the stock price keeps growing the whole time, since it was never sold. The die aspect is that in the US and several other countries, when someone passes away, the value of the stock is reset for tax purposes to its current market value, which wipes out the capital gains tax that would have been applied if they sold it when they were still alive. Now the heirs to those billionaires can then sell that stock and owe far less in capital gains tax than the original owner would have. However, it's worth noting that this only erases the capital gains tax. A separate estate tax can still apply above a certain threshold, though that threshold is high enough that it rarely affects the ultra-wealthy's overall math on the strategy. Put it simply, the strategy is to buy assets that grow, and borrow against them instead of selling, and then pass the wealth on in a tax-efficient way at death. It's how billionaires access huge amounts of cash while barely touching their tax bill, and it's completely legal as well. Chapter 3. Why this is completely legal. This is legal because it comes down to how tax laws are written, because loans are not income. This is because borrowing money isn't actually earning that money, it's cash that you owe back. Income tax only applies to the money that you earn, a salary, a business profit, or gains from selling an asset, and borrowed money doesn't fall into any of those categories. So billionaires can borrow tens or hundreds of millions of dollars and legally owe no tax on it. Compare that to how most people are taxed. Paycheck taxes are withheld the moment you are paid. Sell an investment for profit and capital gain tax is due right away. There's no real borrow instead of sell option for the average person, mostly because most people don't have billions in stocks to use as collateral in the first place. This is exactly why critics argue the strategy deepens wealth inequality. Regular people pay taxes the moment they earn or sell anything, while billionaires can keep borrowing against ever-growing assets indefinitely, deferring taxes for years, sometimes avoiding much of them altogether if wealth passes down after death. So the main beneficiaries from this are the ultra-wealthy, who already holds massive stock or property portfolios, and the banks that profit from issuing these loans to them. For everyday taxpayers, none of this is available, and that gap is fueling one of the biggest debates in modern tax policy. Chapter 4. Real-world examples. This strategy isn't just theory, we've watched it play out with Elon Musk. For years, despite his enormous net worth, Musk reported relatively low taxable income compared to how much his wealth actually grew, since most of it was tied up in Tesla stock rather than cash. The clearest example came during his 2022 acquisition of Twitter. Rather than relying solely on selling Tesla shares to fund that deal, which would have triggered a large tax bill and risk spooking the investors, Musk leaned heavily on margin loans, borrowing billions against his existing Tesla stock as collateral. He did also sell a significant amount of Tesla stock too, but the borrowing let him raise a large share of the cash needed while holding on to more of his position, his voting power, and avoiding an even bigger capital gains hit than he ultimately took. This Elon Musk example is a real-world snapshot of the buy, borrow, die strategy in action, leveraging what he already owns rather than cashing out his full Tesla stocks. And it's exactly this kind of move that fueled public debates about how the ultra-wealthy can access enormous sums of money while paying comparatively little in tax. Chapter 5. Conclusion. So is the buy, borrow, die strategy a smart financial planning or an unfair loophole? This depends who you ask. Supporters argue that billionaires aren't breaking any laws. They're using the tax system exactly as written. Borrowing against assets is a legal financial strategy, and forcing people to sell investments just to pay taxes could hurt businesses and the market in the long run. But critics argue that this lets the ultra-wealthy fund mansions, yachts, and private jets while paying next to nothing in tax, while regular working people pay taxes on every paycheck. This debate has pushed some lawmakers to propose new solutions, taxing unrealized gains before assets are ever sold, or introducing wealth taxes aimed specifically at ultra-high net worth individuals. Whether any of this becomes a real policy is still up in the air, but the conversation isn't going away. So, is this a clever use of the system, or a sign of a deeper problem in how wealth and taxes work today? If you want to watch more videos breaking down topics like this, please like and subscribe, and thanks for watching.